You bring up an interesting point regarding passive investing, and we've been talking a lot on the show about Apple and the reasons why Apple continues to appreciate. How much of that appreciation is attributable to exactly what you're talking about, which is all the moves towards indexing and the passive flows into the market? And is that ultimately a risk if we see a pullback in those flows?
So I think I don't have data, but if I had to guess, I'd say 99.99% is driven by just money going each and every month into passive funds and indexes. And should we worry about that? Yes, because if there's a turn down in the economy and we've seen debt increase so much and people have to start taking money out of those funds, that's when everything turns upside down. So when you hear and talk to people and they're withdrawing money from their funds because they need to use it for their day-to-day life, that's when we have a problem.
Hey, Mark, are you a buyer of stocks recently? Were you a buyer of any of the IPOs, the hot ones of last year, the big name ones, Uber, Lyft, Slack?
No.
Any of those?
No, and not because I wasn't interested, but I'm at Morgan Stanley, and they have all these real weird rules about whether or not I can participate in IPOs and all these funky laws, so I can't actually participate in IPOs. So I haven't. But there were some I liked and, some I would have and would not have purchased. But, again, I'm a fan of IPOs in general. I think you need to bring in fresh stocks into the market. That keeps people interested, and it kind of minimizes the potential negative impact that we were just talking about with passive investing. So I think it's important to have more IPOs rather than less.
It's funny,
regardless of what happens to them price action-wise.
I'm trying to jar my memory from the last time we spoke. Do I recall you telling me last time that you had an opportunity from Travis to invest in Uber early on and you passed?
Yeah, thanks for reminding me.
Is that one of the ones, if you could have bought now, you would have at IPO?
No, exact opposite. That's one I would not have bought. I think if you've been in business 10, 11 years and you still have not gone public, and you're not in that hyper-growth phase anymore, it's probably too late. And, I told that to Travis many times, but, I would not have purchased it. I think, companies need to go public much earlier. You need to be in that hyper-growth phase because that's what distinguishes you from all the other stocks in the market. There's plenty of mature stocks, there's plenty of growth stocks, but there aren't a lot of stocks that are experiencing hypergrowth. And being able to take advantage of the liquidity that it provides, not just the company itself, but all your employees and your early investors, I think really makes a huge difference for companies.
Whether it's Uber or any of these other names, one of the things that we witnessed last year was the notion that growth at any price is over, right? That it was reset.
Yeah,
and that was a good thing.
Yeah, it was a good thing in Silicon Valley, and as Jim knows, I've been anti-Silicon Valley for a long time. When I see these companies that have raised hundreds of millions of dollars to do tens of millions of dollars in business, I run away. And just because they go public is not a reason for me to invest. I'm not, it's really easy to sell dollar bills for 50 cents, and I just don't see that as a real business ever.
That's another difference between 99. The markets handled that rationally. In 99, it was irrational how they rewarded all these companies, and it sunk the market. Now the market's saying, we don't care.
If you, Mark, were taking a company to the public markets today, would you do it through IPO or direct listing?
I don't know enough about the nuances of each to give you an answer.